The analysis identifies the commercial viability of the Advantage2 system as the primary driver for D-Wave, noting that while the market focuses on quantum hype, the engineering challenge of maintaining coherence across 1,200 qubits is the true structural bottleneck. The verdict is a hold until these hardware benchmarks translate into enterprise-scale revenue. D-Wave dropped 7.6%. Lab scores at 54 out of 100. Hold. Investors are fixated on the Advantage2 rollout and its promise of over 1,200 qubits. However, the technical difficulty of maintaining coherence at this scale is stalling the transition from research to revenue. Our teardown reveals if their annealing architecture can actually beat classical supercomputers for enterprise optimization. Quantum computing just took a 7.7% hit across 3 stocks because D-Wave's annealing hardware, a specialized optimization architecture, is a structural liability. While IBM and Google scale gate model systems, universal processors that use logic gates to perform any calculation, D-Wave is physically locked into quantum annealing, a process that only finds the lowest energy state in a mathematical landscape. Their upcoming Advantage2 system boasts 1,200 plus qubits, the fundamental units of quantum information, but these lack error correction. The engineering bottleneck is the Zephyr topology, the specific map of how many physical connections exist between qubits. Without the universal flexibility of competitors like the 1,121 qubit IBM Condor, D-Wave's hardware remains a specialized tool with a hard scaling ceiling that no amount of government funding can fix. The physical reality of D-Wave's chip is a logistical nightmare. It requires millikelvin cooling, temperatures colder than deep space, to maintain coherence, which is the duration a qubit stays in a quantum state. Today's 7.6% drop to $24.27 reflects the market realizing that a $100 million CHIPS Act grant, government subsidies for domestic semiconductor production, cannot overcome these thermal and architectural limits. With volume 44.9% below the 20-day average, the hype around the Nancy Pelosi tracker is evaporating. When you look at the silicon, D-Wave isn't building a general-purpose computer. They are building a high-speed calculator for logistics. As the sector-wide 7.7% decline shows, the capital is rotating out of specialized annealing and toward universal quantum logic. Quarterly financials showing modest revenue momentum for D-Wave. By Q4 2026, the tightening of U.S. export controls will compress D-Wave's revenue growth by at least 20% as the Chinese market becomes physically inaccessible. The macro environment is no longer a backdrop, it is a tightening noose. With the Fed rate at 3.63% and a 10-year yield of 4.47%, the interest rate the U.S. government pays on 10-year debt, the cost of capital is suffocating high beta growth stories. D-Wave carries a beta of 2.06, a measure of volatility where 1.0 matches the market, meaning it falls twice as hard when the benchmarks flatline. The 7.9% recession risk priced by prediction markets is forcing a brutal repricing of companies with minus 80.9% revenue growth. The $100 million CHIPS Act injection was a political lifeline, but it cannot offset the friction of a normalizing yield spread, the difference between long and short-term interest rates. The geopolitical landscape is shifting toward a trade war that D-Wave cannot win. New Trump tariff uncertainties are driving a sector-wide exodus, as export controls, government-mandated restrictions on shipping high-tech hardware, threaten to cut off D-Wave's access to global researchers. The Nancy Pelosi tracker highlighted a 35% surge, but that political signal has become a target for short sellers, who now control 16.8% of the float, the total shares available for public trading. With market sentiment at an extreme fear level of 22, investors are no longer buying the future of computing narrative. They are looking at the 4.3% unemployment rate and realizing that speculative hardware is the first thing to be cut from corporate budgets. The macro wave is crashing, and D-Wave is caught in the undertow. D-Wave reported earnings per share of negative $0.01, beating the Wall Street estimate of minus 0.08 by 87.2%. A solid beat that signals strong execution. D-Wave is trading below its 20-day average, currently at 24.27. Management's headline this quarter, Accelerating Enterprise Quantum Adoption, is a rally cry designed to hide cash burn concerns. The phrase repeats across the 8K, investor deck, and earnings teasers, forcing certainty while the fiscal strain remains. Zero insider trades in the past 90 days signals executives either lack equity access or confidence to double down. Historically, a zero insider window precedes secondary financing or a strategic partnership, not organic demand. The PR touts a $10 million enterprise contract, yet the 8K omits revenue timing, indicating the deal is a multi-year service agreement, not immediate cash. Management says, "We're scaling now." The lab hears future bookings are masking current shortfalls. The quarter delivered an EPS beat of plus 87.2%, 0.01 versus 0.08, a one-off math win that conceals a loss-making core. R&D consumed $51 million, or 206.3% of revenue, up 43.7% YOY, confirming the company remains a pre-revenue R&D sink. The 10Q risk factors cite dependence on government funding and uncertain commercial adoption, exactly what the upbeat press release glosses over. Management claims universal adoption is here. The lab hears we're still chasing the first paying customer. The decisive test will be whether the R&D to revenue ratio falls below 150% in the next 10Q. A drop will prove a real shift from burn to scale. The momentum breakdown for D-Wave. RSI sits at 42, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The bull case for D-Wave relies entirely on the Advantage 2 system proving commercial viability. With 1,200 plus qubits, D-Wave leads in quantum annealing, a specialized method that acts like a marble rolling into the lowest valley of a mountain range to find the best solution for complex logistics. If they can prove this hardware is faster than standard office servers for Fortune 500 supply chains, the current $9 billion market cap is a floor. But here's what breaks the bull thesis. D-Wave is burning cash at a terminal rate, while revenue has collapsed by 80.9%. Their annealing architecture is a dead end for general-purpose AI. Google and IBM are building gate model computers, flexible systems that can run any algorithm, which will eventually render D-Wave's specialized hardware obsolete. The pro-level question is simple. Can D-Wave secure a massive government contract before their cash runway ends? The lab's answer is no. Their forward P/E, the ratio of price to estimated future earnings, of 63.1x, shows a company priced for a revolution, but the bearish MACD, a momentum indicator showing the trend direction, and the 44.9% volume drop, suggest the market has already moved on. If D-Wave secures a major defense contract by Q3 2026, the price could retest the $30.14 resistance level. If they fail to secure new funding, as the 16.8% short float suggests, expect a slide to $18.19 support. The lab's call. The AI score of 54 out of 100 reflects a high-risk rotation trap. We expect a retest of the $18.19 level. Here's the macro picture shaping D-Wave. High federal interest rates make it difficult for D-Wave to fund its expensive hardware research because investors currently prefer safe cash over risky future bets. Recent U.S. export controls on advanced chips also restrict where D-Wave can sell its systems, potentially cutting off major revenue growth from the massive Chinese technology market. D-Wave uses a specialized method called annealing, which acts like a marble rolling into the lowest valley of a mountain range to find the best solution for complex logistics. While they lead in commercial optimization, they face fierce competition from Google and IBM, who are building more flexible gate model computers that could eventually do everything. The biggest upcoming opportunity is the potential launch of their 1,200 plus qubit Advantage 2 system, which could prove quantum machines are finally faster than standard office servers. However, the stock faces a major threat if the company fails to secure a large government contract soon, as they are burning through their available cash very quickly. Today's top signal: QBTS margin compression is structural, not cyclical. Bulls or bears winning QBTS this week? Comment your prediction. This isn't financial advice, just engineer-level analysis for education. Markets move fast. Past performance never guarantees future results. Always do your own research before trading. If you want our full breakdown on NVIDIA, the link is in the description. Subscribe so you don't miss Thursday's deep dive. We're tearing down Supermicro. The lab's verdict stands.